Silver has surged 185% in the past year alone. It hit an all time high of over $100 in January. And Peter Schiff has been saying for years that $200 per ounce is not the ceiling. It is a milestone on the way to something much higher. Most people have been waiting for a reason to believe him. Last week, on July 22nd, why something happened in two completely separate markets simultaneously that almost never happens. Two markets that spend their entire existence disagreeing with each other agreed at the same time on the same day in a way that Schiff says is the clearest signal he has seen since 2008. Today, Peter Schiff explains what happened last week, why silver specifically is the asset that benefits most from it, and why he is no longer saying $200 silver is coming. He is saying the wait is over. Let's get into the video.
I want you to know about two markets. Most people follow one of them. Almost nobody follows both of them at the same time. And the reason that matters, the reason I am starting with this specific framing, is that last week, these two markets did something that gets my attention more than almost anything else I watch. They agreed. Let me explain what I mean by that and why it matters so specifically for silver. The bond market is the largest and most liquid financial market on earth. Trillions of dollars trade through it every single day. Its job, its singular function, is to price what a dollar will be worth years from now. When bond investors are confident in the dollar's future purchasing power, when they believe inflation is under control and government debt is manageable, Treasury yields stay relatively contained and bond prices hold their value. When bond investors lose confidence, when they start demanding higher compensation for the risk of lending to a government whose debt dynamics are questionable and whose currency is losing purchasing power, yields rise and bond prices fall. Gold is a much older market. It has been pricing the same thing for 5,000 years, not what a dollar will be worth. What happens when the dollar's calculation turns out to be wrong? Gold is the market for monetary failure, for the scenario where the promises embedded in paper currency do not survive contact with fiscal reality. These two markets spend most of their existence on opposite sides of the same bet. When the Fed looks serious about fighting inflation and bond yields rise, gold gets sold because higher yields make bonds more attractive relative to gold, which pays nothing. The trade-off is clean and consistent and is held through decades of tightening cycles. A hawkish Fed chair can usually talk gold lower without spending a dollar. On July 22nd of this year, something broke that pattern. Both markets moved in the same direction simultaneously. Bond yields moved higher, which should have pushed gold lower. Gold moved higher anyway, significantly higher. Silver moved even more significantly higher. Two markets that almost never agreed at the same time, on the same day, in a way that has not happened with this clarity since the early stages of the 2008 financial crisis. What does it mean when the bond market and the gold market agree? It means the bond market has stopped believing that the Federal Reserve is going to win the inflation fight. It means Treasury investors are demanding higher yields, not because they expect the Fed to tighten successfully, but because they expect inflation to persist regardless of what the Fed does. And gold is confirming that read. Gold is saying the same thing the bond market is saying. The dollar's purchasing power is going to keep falling, and no amount of Fed signaling is going to change that underlying reality. This is the signal I have been waiting for, not the gold price, not the silver price. The moment these two markets stop arguing and start agreeing, because when they agree, when both the bond market and the gold market are simultaneously pricing in persistent monetary failure, the precious metals rally is not just continuing, it is entering its most powerful phase. Why silver specifically, and why $200 is not the ceiling? I have been saying $200 silver for years, not as a guess, as a conclusion from a set of facts that have been building for a long time and that are now converging in a way that makes the timing feel real rather than theoretical. Let me show you the facts, not one fact, the full picture, because silver's case is not built on one argument. It is built on three completely separate arguments that happen to all be pointing in the same direction at the same time, which almost never happens. And when it does, it tends to produce moves of a magnitude that most people watching from the sidelines cannot believe until it is already too late to participate meaningfully. The first argument is the monetary argument, the one that most people associate with my views on silver because it is the argument that directly parallels my views on gold. Silver has been money for thousands of years, longer than paper currency has existed, longer than central banks have existed, longer than the Federal Reserve has existed. In the same way that gold is the market for monetary failure, silver is gold's monetary cousin. When faith in paper currency erodes, when the debt dynamics of major governments make the purchasing power of their currencies unsustainable, silver benefits alongside gold as an alternative store of value. The dollar has already lost more than 39% of its value against gold in the last year alone. That is not a market fluctuation. That is a structural statement about what the dollar is worth in real terms. And silver, which has historically tracked gold's monetary performance with amplification, has surged 185% in the same period. 185% in 12 months. That is not a silver story. That is a dollar story. And the dollar story is not over. It is getting more severe. The national debt has crossed $39 trillion. The annual interest payment is projected to hit $1 trillion in fiscal year 2026. Import prices rose 1.3% in a single month in February, the largest monthly rise since March 2022. Annualized, those monthly figures produce inflation rates that make the official annual numbers look like they are missing several chapters. The dollar is being debased. Silver benefits. That argument is intact and accelerating. The second argument is the one that makes silver genuinely different from gold, the one that gives it an additional return driver that gold simply does not have. Silver is not just a monetary metal. It is the most industrially critical metal of the green energy transition. And that transition is not slowing down regardless of what happens to the dollar or the Federal Reserve or the geopolitical environment. Solar panels require silver. Each solar panel contains approximately 20 grams of silver. The world installed over 400 gigawatts of new solar capacity in 2025. That installation rate is projected to accelerate as energy costs rise and energy independence becomes a strategic priority for governments around the world. The math is not complicated. More solar panels means more silver demand, and that demand is structural. It does not respond to interest rate cycles or geopolitical crises. It responds to the physical requirements of the technology. Electric vehicles require silver. Each EV uses approximately 40 to 50 grams of silver in its electrical systems and charging interfaces. Global EV sales are projected to hit 40 million units annually within 5 years. That is 2 billion grams of silver demand just from EVs. In a market where global annual silver mining production is approximately 820 million ounces, semiconductors require silver. Medical devices require silver. The antimicrobial properties of silver are driving demand in healthcare applications that are growing as aging populations require more medical intervention. The electronics in every smartphone, every laptop, every server, in every data center that is running artificial intelligence applications requires silver. The industrial demand case for silver is not speculative. It is already in the numbers. Global silver demand has exceeded silver supply from mining for 4 consecutive years. The deficit is being covered by drawing down existing inventories. Those inventories are not infinite. They are depleting. And when a commodity has a structural supply deficit driven by demand that is not discretionary, the price eventually reflects that reality regardless of what else is happening in financial markets. The third argument is the ratio argument. And this one is the most immediately compelling because it is a simple calculation that anyone can verify right now. The gold-silver ratio is the number of ounces of silver it takes to buy 1 ounce of gold. Right now, that ratio is approximately 60 to 1. Gold is trading around $4,050. Silver is trading around $57. 70 ounces of silver buys 1 ounce of gold. The historical average of that ratio over the last century is approximately 47 to 1. The historical average over the last 2,000 years is closer to 15 to 1. In nature, the ratio of silver to gold in the Earth's crust is approximately 19 to 1. Every time the gold-silver ratio has reached extreme levels in modern history, every time silver has become cheap relative to gold in a way that diverges significantly from historical norms, it has eventually reverted toward the mean, not gradually, sharply. The reversion tends to happen in a compressed period of time when institutional money recognizes the divergence and moves aggressively to close it. If the gold-silver ratio reverts to its long-term historical average of 47 to 1, while gold holds at its current price of $4,000, silver would trade at approximately $85 per ounce. If gold reaches my target of $10,000, while the ratio holds at 60 to 1, silver trades at approximately $167. If gold reaches 10,000 and the ratio reverts to 47 to 1, silver trades at approximately $212. $212 per ounce. From the mathematics of two numbers that anyone can look up right now, that is where $200 silver comes from. Not a guess, not a feeling, 3 separate calculations that all converge on the same general destination: the monetary argument, the industrial argument, the ratio argument. 3 roads to the same place. The thing that has always kept silver from going there, and why that thing is ending, I want to be honest with you about something, because I think it is important for understanding why the timing matters now, even if the arguments have been true for years. Silver has been on the verge of this move for a long time. The arguments I just made are not new arguments. They were true in 2020. They were true in 2022. They were true in 2024. And yet silver has repeatedly approached its prior highs and then pulled back, frustrated the investors who understood the fundamental case, and given ammunition to the skeptics who said the move was always 10 years away. There is a reason for that, and understanding it is what tells you why this time is genuinely different. Silver is a thin market, much thinner than gold. The total value of the global silver market is a small fraction of the gold market, which means that institutional money, the large pension funds and sovereign wealth funds and hedge funds that move the needle on major asset prices, has historically been able to ignore silver without feeling like it is missing something material. Gold has attracted that institutional attention first, and for good reason. Gold is the simpler monetary argument. It is the established reserve asset. It is what central banks buy when they are de-dollarizing, and central banks do not buy silver, not yet. But here is what changes when gold reaches the prices it has been reaching. At $4,000, at $5,000, at the levels gold is approaching on the way to my $10,000 target, the capital required to build a meaningful gold position becomes genuinely large. A $1 billion gold position at current prices represents approximately 225,000 ounces. That is a meaningful piece of the market. The same $1 billion in silver at current prices represents approximately 13.5 million ounces, which is also a meaningful piece of the much smaller silver market. But silver's smaller market size means that when institutional money rotates from being underweight silver to being appropriately weighted in silver, the price impact is dramatically amplified relative to gold. This is the dynamic that drives the ratio reversion, not slowly, explosively. When institutional money decides it is time to own silver, the market is too thin to absorb that demand at current prices. The price has to move higher, significantly higher, to bring enough supply to meet the institutional demand. That rotation has been beginning. Silver's 185% gain in the past 12 months is evidence that it has started. The July 22nd signal, the simultaneous movement of gold and bonds in a direction that says The inflation fight is not won, is the kind of macro confirmation that accelerates institutional rotation into precious metals broadly and silver specifically. Do not wait for a pullback. And here is exactly why. I said something in a recent interview that I want to repeat here because I think it is the most practically important thing I can say to anyone who has been watching the silver rally and waiting for a better entry point. Do not wait for a pullback, not because pullbacks will not happen. They will. Silver is a volatile asset. It corrects sharply and it recovers sharply. Anyone who has watched it for more than a year knows this. The drawdown from the January high was painful for people who bought at the peak. But here is what the people waiting for the pullback are missing. Silver has already broken out above the resistance levels that capped it for decades. The $50 level, the $70 level, the $90 level. These were not technical levels that happened to be near round numbers. They were the price ceilings of the previous era of the silver market. The era when silver was primarily a monetary hedge for a small community of gold bugs who were dismissed by the mainstream. That era is over. Silver at $57 is not silver at the start of a move that might go to 75. It is silver that has broken through resistance levels that held for 40 years and is now in a regime where the old price ceiling is the new price floor. When a market breaks through multi-decade resistance in this manner, when the technical structure of the market changes this fundamentally, waiting for a pullback to the old resistance level is like waiting for the NASDAQ to come back to the levels it held in 1995, because those levels felt more comfortable. The market has moved into a new regime. The old reference points are no longer relevant. The people who said silver was expensive at 50 are now saying it is expensive after a more than 50% pullback from over $100 at the highs. The people who said it was expensive at 50 will say it is expensive at 100. And the people saying it is expensive at 100 will watch it go to 200 with the same disbelief they have brought to every previous level. I think $100 is a very realistic target for silver in 2026. It could end up being quite a bit north of that. I said that at the beginning of this year. Silver was trading below $70 when I said it. It hit over $100 in January before the Iran war created the short-term headwinds that pushed it back. And I am saying now, with more conviction than I had in January, that the path to $100 and well beyond is not just intact. It is accelerating. The July 22nd signal matters because it tells me something specific about timing that the fundamental arguments alone cannot tell me. The fundamental arguments tell me where silver is going. The bond and gold market signal tells me when the institutional money that drives the most powerful phases of these moves is starting to see what I have been seeing for years. And when institutional money sees what I see in silver, when it starts doing the same ratio calculations I just walked you through and recognizes that silver at current prices relative to gold and relative to its industrial demand profile is one of the most asymmetric opportunities in any asset class, the move from here will not look like the moves that have already happened. It will be bigger, faster, and far more surprising to the people who have been waiting for a more comfortable entry that the market is not going to give them. I have been waiting for this signal. It arrived last week. The wait is finally over.
185% in the last 12 months. A $200 target from Peter Schiff on record, 3 completely separate arguments, monetary, industrial, and the ratio, all pointing to the same destination. And last week, 2 markets that almost never agreed. Whether you believe Schiff or not, the arguments deserve to be understood before you decide, because the move he is describing, if it plays out anywhere near the way the 2008 gold comparison played out, will not wait for everyone to feel comfortable before it leaves. Your action this week: calculate your gold-silver ratio right now. Take the current gold price, divide it by the current silver price, write down that number. Then decide whether you believe that number is where it belongs, or whether the reversion Schiff is describing is coming for it. What do you think? Are we about to see an explosive move to $200 in silver? Let us know in the comments below if you agree or disagree with Peter on the silver price target. And as always, I will see you in the next video.